companies should allocate innovation investments based on the business's future potential, not on today's needs. Let's see how companies do this today. We identified two main portfolio types, each with a different investment strategy. Mature portfolio companies, which amount for 3/4 of the sample, generate most of their revenue from legacy businesses. On the other hand, balanced portfolio companies, only 1/4 of the sample, generate most revenues from both growth and emerging businesses. In the next 5 years, the picture looks pretty much the same. Although there are some mature portfolio companies that will become more balanced and vice versa, these are the exception. In general, we found that mature portfolio companies tend to invest for longevity, while balanced portfolio companies distribute their investments more evenly across their portfolio. Were they doing this as a conscious decision or out of inertia? As you will see in these charts, the largest business by revenue are taking the lion's share of innovation investments. Even when most of the executives surveyed said that their newer businesses had higher growth potential. This bias is so strong that on average, for every 1% in revenue contribution, businesses get a 1% share of the company's innovation money. For example, mature portfolio companies are directing about 60% of their innovation investments to their legacy businesses. This 1-to-1 ratio between share of revenues and share of innovation investments became less surprising when we looked at the approach for allocating innovation investments. We found that only half of companies invest strategically based on the future potential of their businesses. The other half allocate their investments with short-term needs in mind, either based on the current size of their business or based on the most pressing short-term needs. That's like using your pension savings to pay your overdue electricity bill. Julian Birkenshaw shared with us his point of view.
As an established company, you can't completely replicate what the private equity and venture capital companies are doing, but you can absolutely learn something from them. You need to give them special attention. You can't expect someone running an existing business unit to invest in something where the returns are coming 5 years down the road. They're not going to be around 5 years from now. So it's a corporate level decision to say, let's divide up the money and let's make sure that, let's say, 10% of our innovation portfolio is put into these game-changing innovation ideas, and to treat that a little bit more like a venture fund. Now, of course, that's going to take time. Of course, it's going to take a certain amount of risk. But you've got to do that if you're going to compete with the big VC firms, which are kind of snapping at your heels.
Companies need to determine how the composition of businesses in their portfolio will need to evolve in the future so that they can set their investment strategies accordingly. Will the company innovate for longevity, or will it innovate for balance? We have found that when it comes to innovating for longevity, a company's focus should be on increasing non-incremental innovation, that's breakthrough or disruptive, in their legacy business. Our research shows that when mature portfolio companies focus on intensifying only non-incremental innovation, twice as many of them expect double-digit growth in their legacy business compared to their less focused peers. Of course, this will not be easy. Large companies have evolved to be particularly efficient at what they do, and any non-incremental innovation will threaten either the efficiency of the machine or even its core structure. But considering the higher expected payoff, it might be worth it. When innovating for balance, we found that the focus should shift to increasing both incremental and non-incremental innovation. As the graph shows, among balanced portfolio companies, those following a more pervasive approach were twice as likely to expect double-digit revenue growth compared to their most focused peers, who will only intensify one type of innovation.